Hi everyone, welcome to the option trading course co-hosted by SignalPlus and OKX. And this is the a FAQ session, as we have received many feedbacks and many suggestions, and also some questions around how to use the SignalPlus dashboard, as well as some tips or some techniques around options trading. So we're now here to organize a FAQ session to explain some of the concepts, also some of the questions to everyone here. As the King of Option Trading Contest, co-hosted by SignalPlus and OKX, have started for around 2 weeks, and the competition period is going to end on the 30th of June. So to trade for a share of 115,000 USDT prize pool, you can join now and be one of the winner in the competition. So the first question we've got is, why trade options? This is actually a very good question that many people are struggling and thinking, why do they need to use options as a trading tools? Actually, in TradFi, many traders are using options as they want to get access to a very, very high leverage. However, in crypto, high leverage is relatively accessible to traders. So we can easily go up to like 10x or even 20x very, very easily from the futures market. However, there are still many reasons why we need to use options in our trading or our portfolio. The first reason is to boost reward for spot. As we have mentioned on the first session, other than placing a buy or a sell order on the spot book, if we utilize option as a tool, we can earn some premium while doing that as well. So looking at the option chain, there's actually an APR column here. So for example, if I'm holding some Bitcoin and I'm planning to sell at around $28,000, instead of placing an order in the spot book, if I'm selling call at the same time with strike price 28,000 and doing that over and over again, once the price hit 28,000, instead of just selling the Bitcoin, I'm also able to earn an around 20% APR suggested from the current market premium. So, but even if I'm not able to, the price didn't reach 28,000 and I'm not able to sell, I was still able to earn this premium. So comparing to just doing it on spot market, option can actually boost the reward. Secondly, options can also be treated as a method to hedge the market movement. So currently, as we know, futures is often also being used to hedge some of the price movement. For example, if an ETH node operator has staked a few nodes, and if he is afraid that Ethereum price might drop a lot, he want to keep the face value of his Ethereum, he might go to the futures market and open a short position in Ethereum. So when the price goes down, even though his ETH that is staked worth less, but his short ETH position will also earn a lot of money from it. So it's offset the drop in value from his staked Ethereum. So that's how he hedged. But however, if the price goes up, his short position will also lose money. So actually, he's not able to enjoy the upside nor downside from the market. And I know that many crypto traders, especially holders, might not want to experience this, as they're holding Ethereum, they might want to enjoy the upside as well. So in this case, instead of selling futures or selling perpetuals, they can actually buy put options. And options in this case actually acts like a insurance. act like an insurance. So if I do not want Ethereum to drop to break around 14,000, 1400, yeah, 1400, I'll buy a Ethereum put, long put option with strike price 14,000. So if the price really drops and go below 14,000, I would be able to sell. It means that I have sold my Ethereum at 40,000. However, if the price goes up, my maximum loss in this long put option will just be the premium I've paid for this position. So I'm just paying some premium, or we call it to buy an insurance to protect the downside. While when Ethereum price goes up, I'll still be able to enjoy the profit from it. So this is how the insurance is going to work. Another example is, let's say I'm a Bitcoin whale and I want to buy something with cash, with fiat. So in this case, normally I would sell all my Bitcoin and just cash out to fiat and maybe buy the things I need. But however, if the price goes up now, I would have missed all the price upside of Bitcoin, right? In this case, I can actually, other than use some part of my capital to buy a long position in the futures market, I can also spend a little money, a small amount of money to buy call options to make sure that if the price goes up, I'm still able to enjoy part of it. So that if in the PowerPoint I'm saying fear of missing out, yeah. So if you still want the spot exposure on this asset while you're not able to have the full amount of it, or you have to cash out some of it, you're still able to pay some premium to obtain a call option and to enjoy the upside of it. And the third reason, actually, before we go to the third reason, we can look at this is the BTC price chart. And when we look at the 1 hour candle that was printed 2 days ago, when CPI is out, when CPI this month was out, we see that the price goes up by a lot and then goes back down. The red candle in the middle, we can see the price fluctuates a lot. So when we, yeah, this is, remember this. So there are some scenarios that traders cannot predict the price will go up or down, because yes, we know for many of the macroeconomy news or events, we basically cannot predict if the market is going up or down in this case. But what we know is the price is going to be very, very volatile. There's around $600 movement in an hour. On the other side, this is a screenshot of May. May, this basically last month, 2023, May. We can see the price is actually not moving. It's just consolidating in a very, very, very short range. Oh, sorry, it's the May 2022. After the lunar crash, the price has been very, very stable for a long time. BTC range was around around 1 to 2,000 at that time. So it's around 8% at that time. It's not moving at all. So in this case, if we are a Bitcoin trader and we're just trading the direction up or down, it's actually very, very hard to profit from this period because the price is basically not moving. So actually, instead of just trading up or down with options, we can also trade the volatility. We can try to trade if the market is moving or not. So for example, if for some upcoming events like FOMC or some lawsuits around crypto events, we can actually predict if the market is volatile or not. So from the two screenshots below and at the bottom of the screen, it is actually a long straddle on the left and short strangle on the right. For the left one, if the price moves a lot, moves to like in the left from move downward or upward, no matter which side, traders will be able to profit. So in this case, we options trader can actually speculate volatility instead of one direction. No matter where the price moves, as long as it's moved big enough, the movement is huge enough, trader will be able to profit from it. On the other hand, when we're looking at the right screenshot, let's say short strangle, we profit the green sized profit. We profit when the price stays between 24,000 to 27.5 thousand. So if the price doesn't move and stay as stable as it could as current, traders will be actually able to profit from this stable market. So when we're looking at market like this, the market is not moving. If we're doing some short volatility strategies, we're able to profit from it. And this is also why we would like to trade options. Instead of trading a specific direction, we can also trade volatility. The last reason of trading options is to express a specific view in the market. So for example, I'm thinking the price might go up and then down, or the price will stay in this range. So when there is a very, very specific view in the market, we could actually trade use option to obtain this view and maximize profits. So for example, on the right, the screenshot is showing a bull spread, or we call it call spread. And with this trade, traders are actually speculating the price will stay above 26,000, but below around 27,000. It will stay in this range. So if he is right, if the price really stay within this range, the profit will be maximized, other than just buying a specific call. The second question is, what's its initial margin, IM, and what is maintenance margin, MM? So for this question, it says IM and MM is actually something that we need to understand when we trade options or even futures. So actually, the option margin amount is based on the amount of seller positions, open orders, and the buy positions. So initial margin is basically when initial margin is higher, it means you have already used many of your margin of your capital in the position. So the higher it is, the less extra option positions you can open. And for maintenance margin, it is actually determining when is the trader going to be liquidated. So when the maintenance margin reaches a certain level, for example, 100%, the liquidation engine of the exchange will actually partially close your position, to close your orders, and to maintain maintain some levels. So actually, for IM, we just need to make sure that it is not really high, so that we can open extra position to hedge. But for maintenance margin, we need to maintain it at a relatively healthy level, because it is determining when will liquidation happen. So for me, as we are opening portfolio margin or unified margin when we are trading options, so it is healthier when we can keep our margin at around 30 to 40%. I would say this is a well-utilized and safe zone for well-capital usage. But of course, in some uncertain market situation, we should keep both of them as low as possible, so that it's more flexible for us to have some extra actions or like follow-up actions. So the third question is how to open option positions and analyze P&L through the SignalPlus dashboard. So within the dashboard, you'll actually find a module called Classic. And in this module, traders will be able to look at their margin, the account summary, trade futures, and view their positions. Also look at the options chain so that they can start to look for some expiration date and the corresponding strike price and open and buy or sell options. And after they have selected, you have selected the option position, you can click the sell in the option chain directly, and there will be an order window pop up. So after that, you can choose the corresponding price and quantity and place a buy or a sell order. And for P&L analysis, we can go back to the dashboard and click the plus button and go for the professional interface. And in that interface, there will be a few widgets that help traders analyze their P&L, also risk. So the first tool we can use to analyze P&L is this SignalPlus Live Risk P&L widgets. So there will be a few parts. The first part is to show the day's P&L. So how much was the P&L in different instruments? And the second part, we're breaking down these P&L into different risks, so that we can know if we are earning or losing money from the price movement, from time, from fees, or the change of implied volatility. This is very useful for us to, when we're trading, as we should always be aware of the reason we're earning or losing money so that we can adjust accordingly. And the second thing we can look at is the SignalPlus P&L attribution. So in this widget, the interface is showing the P&L of every day, with it breaking down into different groups, so that we will be able to view the P&L caused by different the different factors historically. So that let's say for the 23rd of February, I'm losing money from Delta because it's negative, and losing money from fees, but earning money from implied volatility from Vega. And when we're looking at 25th of February, and we will be able to see the breakdown when we're hovering it, then this trader is earning from Delta, losing from Gamma, and earning from Theta. So it is very useful to break down Greeks and look at the historical numbers. So the next question is how to settle short options physically. Before answering this question, we can first explain what is settling options physically. So for example, when I'm selling a call, and so it means I would like to sell my, let's say, BTC at a certain price. So when this sell call is being exercised, it means I'm selling BTC at the strike price if this is exercised. But as we know, all options in crypto are actually cash settlement, which means it is only changing the P&L in margin currency. It will not really sell my BTC in the market. So this is actually something we need to do it ourselves. And when we're saying settle options physically, which means when the option expires, we need to sell our BTC at the same time. So I need to convert my BTC into USD or USDT. This means I'm physically settling my short call. So here is an example. If I hold 1 BTC and I sell 1 BTC call with strike price 30,000, which means I'm willing to sell my BTC at 30,000. However, if the current price is at 31,000, which it means it is higher than the strike price. Hence, this call options will be exercised so that I will be selling my. It means I'm trying to sell one BTC at 30,000, even though the current price is 31,000. However, if we just let the we don't do anything and let the call option position settle, I'll still be holding BTC, but I'll be losing some of my BTC value because economically speaking, I've already sold my BTC at 30K. So this is not actually what we want to do. As the first question said, we want to boost sell BTC at the same time. So in this scenario, we should actually sell the BTC in the spot market at the same time. However, there are also some scenario that as we look at the settlement price in OKX, the exchange actually starts settling position 1 hour before expiry time, where the expiration time is actually 8 a.m. UTC 0. So the position is starting to be settled from 7 a.m. UTC, which means settlement means the settlement price is being determined from 7 a.m. So that instead of selling everything one off at 8 a.m. UTC, we should actually start selling slowly from 7 a.m. to 8 a.m. Because from the definition of settlement price from OKX is the arithmetic mean of underlying index, which is BTC, 1 hour before expiry time. So we should split the BTC into many, many pieces and sell it very, very slowly, so that we can make sure that the selling price is equal or very, very close to the settlement price. And this is how we can settle short call option physically. For short put option, we can do the same, but we're actually buying the underlying coin, which means BTC, in the spot market. Okay, so the next question is how to roll options positions. So I think many of the participants here might not be very familiar with the concept of rolling options, rolling positions. So when an option position is in profit or loss, there are actually only a few options. The first one is, we hold till expiry. We don't care how is it going, but we just hold it. Or but some of us might be worried that the price goes up and then go back down. So we might lose all the profit from the call position. So we might close it in the market. However, sometimes the market does not have enough liquidity for us to close in the options market, so that we might open a futures position to hedge option position, which is what we mean by hedge delta. For a call position, when it's in great profit, we could sell an equal portion of futures position to hedge the price movement. However, there is also one more option, which is roll position. It is something that we use to manage options portfolio when we're in profit or loss. Yeah, so roll options means we're closing out an existing position and opening a new one. So for example, I'm currently opening a long call position. To roll it, I would close this long call position and open a new one with different strike price or different expiration dates. So why are we doing this? There are a few reasons. The first reason is we adjust the risk-reward profile of the position, which means we want to reduce some of the premium, or just change some of the Greek exposure to change the risk and reward, or to take profit, or to delay the expiration or delay the settlements. So actually, there are three ways to roll option. The first one is roll up, which means selling an option with selling the current option with the strike price, sell the current strike price, and buy an option with a more far strike price. So, for example, I'm having a 26,000 long BTC call with strike price 26,000. So, as we're now very close to 26,000, so I might roll up. I would sell this 26,000 call and buy back one with strike price 28,000. With this operation, I have actually reduced the premium I'm going to pay. So if the price, because a 26,000 call is way cheaper than a call with strike price 28,000. It's way more expensive. Sorry, 26,000 call strike price 26,000 is more expensive than one with strike price 28,000. So with this adjustment, even if the price goes back down or it doesn't go up anymore, the premium I've paid will be less, and hence it means I've partially taken profit from the old option position. The second one is roll down. I'm selling one option with farther strike price and buying back one with closer strike price. Why are we doing this? That's because when we think this is less likely to be exercised as settlement, we might try to reduce the increase the chance of it getting settled, and hence getting more chance to get it settled and the chance of be in profit. So for example, today the price is at 26,000 and I'm having a call with 29,000, and I think it is very, very less likely to be in profit. So instead of holding it till expiration, I would sell it and buy one with a closer strike price so that I will be more likely to be in profit, even though I pay more premium. So it's actually the reverse of the previous option. For the last one, roll out. It's basically the same as buying calendar spread, which means I'm selling the short-dated options, which I'm having right now, and buy one with longer expiration date. So for example, my options position is going to expire this week, but I think I don't want it to expire, and I'm still bullish on the market. So I'll sell the call option that's going to expire this week and buy back one that is expiring a month later. And it's because I'm very bullish to the market, and I think that the market will eventually go there. So I'm actually delaying the assignment, or we'll call it trying to make it not settling at this moment, and try to move the option position to a later one. And the next question is, what is DDH? How to set up a proper DDH? And before we start this topic, I think we should talk about what is DDH. Dynamic delta hedge. And in the beginning of this session, we've already gone through what is delta hedge. It means we want to hedge the price movement of the position of certain assets of a position or a position, so that we just go to the futures market and directly open a position with opposite direction. So when the price goes down and I'm holding the assets, I don't lose money. But when the price goes up, I will not earn money from it as well. As for dynamic delta hedge, as in the options market, delta is always changing when price moving because of gamma. So a dynamic delta hedge means when delta is changing, we also hedge gamma. We also hedge the delta dynamically. When the price goes up, we might hedge more or hedge less. The price goes down, yeah, we also might hedge more or hedge less from the futures markets. So first, we would like to explain what is buy or sell side DDH. It is actually determined by gamma. And for buy side DDH is actually buy low and sell high. And for sell side DDH is buy high and sell low. So as if the gamma is positive, it means when the price goes up, I'll be having more delta. When price goes down, I'll be having less delta. So when price goes up and we want to keep delta at a very, very stable level, it means we will be shorting more and more futures market. And however, when price goes back down, it means we'll be having less and less delta, and delta will be going negative in this case. So in this case, we would buy back some of the delta. In this case, we're actually buying low and selling high from futures markets. On the other hand, if the gamma is negative, which means when the price is going up, I'll be having less and less delta. When the price is going down, we'll be having more and more delta. And to keep the delta at a stable level, when price goes up, as gamma makes us selling more delta, and we will have less and less delta. So we need to buy back some delta from futures region to hedge when price goes up. On the other hand, when price goes down, we would sell. So we're actually buying high and selling low to hedge negative gamma. So in this scenario, some might ask, when we are selling, for the sell side, we're buying high and selling low, and it is a stupid trade that every futures trader that know we should buy low, sell high, right? All futures trader or spot trader should buy low and sell high. So in this case, why are we buying high and selling low? Let's recall, this is actually a delta hedge. We're trying to hedge from price movement. And in what scenario we will be in a sell side? We'll be selling gamma, short gamma. It's actually when we're shorting volatility, we'll be selling. We'll be doing the sell side when we're shorting volatility. So when the price moves up and down while we're selling volatility, of course, there's chance to lose money here. But it is when we're shorting volatility, this DDH helps us hedge the scenario that when price goes straight up to all-time high or all-time low. This delta hedge will help us prevent losing money from this kinds of scenario. But if the price keeps crabbing or is fluctuating at a up and down, this buy high sell low will cost us money. But this is still something that we might consider doing, because when there is black swan, then when we're shorting volatility, we might lose money from it. And this is the configuration when we are setting up DDH. For the first box, it's the upper limit. It is and the bottom box is lower limit. This limit is the trigger of the DDH. Because delta is always changing when price changes. And when it reaches the upper or lower limit, the system will help us start hedging, start using futures as a tool to hedge the delta. And it will hedge until it goes back to the target field, which is also being set by us. But as we know, it is not that easy to hedge exactly as the target. So there will be a tolerable range that we stop hedging. So we can also set the tolerable range for our own risk appetite. So this is actually hedging starts at the top part and the bottom part, and the robot will help us make our delta to the middle of the range. And this delta value can all be set by us. So there's also one interesting question is how do we determine the timing to sell put options, because especially in the recent market, I mean, yeah, maybe in 2022, the price keeps going down when there's macro event or crypto black swan event. So when traders keep selling puts, they might be suffering from a huge loss because the price keeps going down. So this is actually my own experience. There's actually a few ways to determine the timing of selling put options. So when there are some foreseeable macro events or crypto events happening, we'll usually see some huge surge in implied volatility. In this case, this is the first scenario we can start to short puts. And also we can figure out what we're trying to profit from. If we're trying to profit from a delta movement, which means we want to earn from the price going up, we can try to sell long dated out of the money puts. And if we're trying to profit from a time decay from theta, we can actually sell short dated at the money puts. So when the price keeps stable and time passes, this is the most profitable way to do it. Of course, if we want to minimal the effect of price movement, we can also have a dynamic delta hedge open so that when there's huge movement, we can protect ourselves from it. And the last question here is, what are the trading patterns for OKX? Actually, as we see, as I also observed this in the market, there are actually some pattern that we need to keep in mind, especially in the OKX options markets. For example, on Friday, when the options are almost expire or right after expiration, the liquidity will be quite insufficient for us to open or close position. So this is something we need to bear in mind, and yeah, look at the liquidity when we trade, because we might suffer from unnecessary loss if the liquidity is not good enough. And yeah, so some big liquidity will not be there on Friday most of the time. Also, in weekends, some of the liquidity will also be quite bad. And for in the money options, it's also something that we need to bear in mind. If our option position is almost expire, but it is become in the money, we might need to do delta hedge instead of options trading. I mean, trade closing from the option market, because the liquidity might not be sufficient for us to close it out. However, as we see in some of the out of the money market options from long dated and short dated, for both long dated and short dated, the liquidity is actually quite good, and it is so that it's quite sufficient for us to express our market view from the options trading market. But yeah, this is just something that we need to bear in mind when we're trading. So just look at the order book, and maybe if we want to maintain a good portfolio, we can also use smart dealing functions to make sure that we can fully utilize the OKX liquidity when we're trying to start some options portfolio. And this is the end of today's FAQ session. And if you still have any questions, feel free to join our daily Q&A session that will be held in the community. And also, if there's any questions around the OKX trading, OKX options trading, the trading composition, or the use of the SignalPlus dashboard, feel free to ask us in the community. And thanks everyone for joining today's session. Thank you.